Who's ever watched one of those awesome house flipping shows where somebody buys a nasty ass property, fixes it up, and then walks away with a ton of money? Yep, it looks exciting on TV. But the real question is, how do these investors actually pay for those deals? Hey guys, I'm Ivan Simmental, the broker owner of The Mortgage Standard, and I've been in the mortgage game for 11 years now. Dang, it sounds like a lot just saying that. And I've seen just about every type of financing strategy out there. One of the most interesting ones, and one that I get asked about constantly, is the fix and flip loan. If you've ever wanted to break into real estate investing, for that fact, this is one of the most powerful tools to get started, and you can have your own show like Chip and Joanna Gaines and all those cool people that start flipping and then they become millionaires because they get it. But before we jump in, take a second please to hit that like and subscribe button. When you do, this helps this kind of information get out to more people who actually need it. And at the end of the day, it's not about algorithms, it's about helping people learn how to build wealth and create options for their families, and that's why we do this. All right guys, so let's talk about how fix and flip financing really works. At its core, this is short-term financing designed specifically for investors. So you buy a property, you renovate it, and then you sell it in the simplest terms. Most loans are structured as a 12-month or a 24-month bridge loan, meaning that you have 1 to 2 years to get the rehab done and close out the deal. It's not meant to be a 30-year loan or a 15-year loan or a 20-year loan. It's designed to help you move fast and get in and get out with profit. Now, I'm very familiar with these because we've done several of these ourselves, and they are a great tool for anybody that's looking to start fixing and flipping, but they're not very easy to get a hold of, right? So now let's hit some key guidelines and talk about what's important. First of all, the loan size. Most lenders want to see at least $100,000 borrowed, and there are some who will go as low as $75,000, but that is usually if the deal makes sense. Now, the cost of money is too high and the lender has to make their margin, so that's why they want it to be at least $100,000 or so. Of course, the bigger the better. Next, we have credit. Typically, you're going to need a credit score of 680 or higher to get decent terms, right? If you have lower credit, it doesn't really make sense for you because the terms are going to be awful. And so if you're going under that, like I said, there are options, but expect higher cost and the requirements are going to be a little bit tighter. My advice is, if you got the time before your first project, work on your credit. Make sure that it's good because it does make a big difference. Now let's talk about down payment. Usually you're looking at around 20% down, sometimes more, sometimes less if you're an experienced investor, right? So for us, we put around 10% down usually for our flips, sometimes nothing depending on how we structure the project. And so on top of that, lenders like to see reserves. Typically it's anywhere from 4 to 6 months of the payments set aside. It's just a safety cushion that proves that you are responsible and that you're not stretched too thin. So here's one of the parts that surprises people the most. A lot of these programs will finance up to 100% of the rehab budget. Yes, all of it. So that means if you've got a $40,000 renovation, the lender can cover the entire thing. You'll do the work, submit for a draw is what they're called, and then you get reimbursed along the way. It's huge because if you are a new investor who doesn't have a lot of money, just stored in, your piggy bank or under your bed or wherever, this helps you get that money back. So now I want to talk about the cost of these type of loans. Now rates are higher, of course. Think of double digits typically, usually somewhere in the 10 to about 14% range. And there are points involved, though believe me, there are points involved which really do suck, but the name of the game, it's game of the name. Well, you know what I mean? It sucks. Typically, you'll be charged anywhere from 2 to 4 points. Yes, like I said, it is expensive, but remember, this is a short-term loan designed to give you leverage. So you're not paying 10% for 30 years. You're paying it for 6, 12 months, 24 months at max while you flip your property, and hopefully you make tens of thousands of dollars and don't go broke and bankrupt. But anyways, make sure that you run your deal. Another thing that I really want you to know, or really important, is the ARV. And so the ARV simply stands for after repair value. And so that is what the property is expected to be worth after the rehab is done. Most lenders will cap financing at about 70% of ARV. So for example, if the finished property is going to be worth $300,000, the lender might give you $210,000 in financing. That way there's enough cushion in the deal to protect you and them. So it protects them them, if you can't pay for it or you can't, do what you said you needed to do, they just turn around and sell it. Right? So it gives them enough cushion to still make the deal work for them. So I want to give you a quick example. Say you find a property for $160,000 and you plan to put $40,000 into it. When it's finished, it'll be worth, let's say $300,000. Your all-in cost now is $200,000 and the ARV is $310,000. That spread is what makes the deal work. The lender covers the purchase price and the rehab, and when you sell, you pay them back and you keep the profit. Simple, very easy. Very powerful. Get the point? Awesome. Now, if you are a first-time investor, the terms might be a little bit tougher, higher down payment, stricter reserves, but as you gain experience and you prove that you can execute, lenders open up a lot. Lower cost, lower down payment, more trust, a little bit more flexible. It's very much a track record type of business. And especially if you are working with the same hard money investor or the same fix and flip investor that we work with, they will give you more leverage or more leeway on certain things after you've $200,000, 5, 6, 10 deals with them. The more that you flip successfully, the better the financing gets. Just point blank. So if you've been thinking about getting into real estate investing, a fix and flip loan could be the way to do that. It's not for everybody. So please don't just, try to do the HGTV way and, it's very, very fast paced. It's risky and it does require you to be organized. But if it's done right, it can be life changing after several flips or after doing this as a career or doing this for many, many years. If you want to see if your deal pencils out, I'll drop my calendar link below. Let's talk through it and see if it makes sense for you. And guys, please don't forget, hit that like button and subscribe. Every time that you do, you're not just supporting me, you're helping spread financial knowledge to people who need it. Thanks for watching, and I'll catch you on the next one.